Good morning and welcome to the Killik and Co market update. Markets have been a bit unsettled this week as the yields on government bonds continue to be in focus as investors worry about overall levels of government debt. Here's the chart we showed last week about the rising government bond yields across different countries. This week, the UK's 30-year bond yield hit its highest level since 1998. And part of the reason for this was the publication of the UK's autumn budget date. It will now take place on the 26th of November, which is significantly later than previously thought. We had been expecting a date around about the end of October. The delay has led to speculation that the government is either planning something quite dramatic or that it's not entirely sure what to do and therefore it needs to give itself more time. Neither scenario is particularly positive, and therefore we saw this rise in UK government bond yields as well as a drop in the value of the pound. Here's the pound against the dollar over the last year. In that pink box there on the right, you can see that the pound has dropped this week. This is bad news for the UK, but it is good news for anyone investing globally but valuing their portfolio in sterling, as overseas stocks will now appear to be worth more in sterling terms. Gold has hit yet another record high this week, and the price of gold is now up 40% over the last 12 months. Gold has traditionally been viewed as a safe haven, and it's possible that some investors are moving out of government bonds and into gold. Gold has outperformed the global stock market over the last year. On here, we're comparing the gold price in the green against the MSCI World Index in the pink. Back in March, when all those tariffs were announced, you can see that stocks dropped while gold rose, and the price of gold has simply carried on climbing. The rise in the gold price has clearly been good news for gold miners, who will now be more profitable. Here's the share price of Newmont, the world's largest gold miner. The shares have been tracking the gold price higher since March. There are a number of so-called multi-asset funds that hold a variety of different assets and aim to preserve capital against inflation whilst exhibiting a low level of volatility. Typically, these funds will hold a combination of stocks, bonds, and other assets such as gold. A good example is the Personal Assets Trust, which has been trading on the stock exchange since the 1980s. Here's the current breakdown of what it holds: 39% in stock, shown by the green, a good selection of different types of bonds, and 11% in gold, shown by the pale green. Some of these funds have had a difficult time in recent years. All the quantitative easing carried out by central banks following the financial crisis has disrupted the previously accepted correlations between equity prices and bond prices. And furthermore, the gold price has endured long periods of weakness. However, many of these funds have benefited from the recent strength in the gold price. Here's the 10-year price chart for the Personal Assets Trust. You can see a period of very limited growth from 2016 to 2019, but more recently the performance has picked up. So do give us a call for our thoughts on the Personal Assets Trust. And lastly, a few bits of company-specific news. The latest FTSE 100 quarterly reshuffle has been announced, and as always, it's helpful to have a look and see what companies are doing well and what companies are not doing so well. Fashion company Burberry is now back in the FTSE 100 following the launch of a new strategy and a cost-cutting drive. Metlen Energy and Metals is actually a Greek mining and energy company that moved its listing from Athens to London this year, and that was a nice vote of confidence in the UK market. The two relegations this quarter are Taylor Wimpey and student property company Unite Group. High interest rates and the squeeze on the cost of living have been bad news for property demand and therefore property prices. And finally, just one other bit of company news that we wanted to squeeze in at the end. A US court has ruled that Alphabet does not have to sell Chrome, its browser. There had been speculation that Alphabet might have to do this because of its monopoly power. Here's browser market share. You can see that Chrome currently has nearly 70%. Shares in Alphabet gained over 7% when this news came out. Moving on to have a look at next week, it's looking very quiet on the calendar, and there are no companies on the Killik covered list scheduled to report. So have a great weekend, and we look forward to seeing you next Friday.